Welcome to the video for valuation of bonds and shares. In this video, we'll look at the fundamentals of bonds and debentures. Now, what is a bond? A bond is a long-term debt instrument or security. So the question is, what is debt? So debt is nothing but loan which the borrower gets from the lender. So there are many instruments where a borrower gets loan from the lender, and bond is one type of that loan. Instrument is used for financial assets like bonds, debentures, shares, etc. So let us understand how these bonds work. So let's say this is one entity and this is another entity. Let's say the entity in blue represents government, PSUs, that is public sector units, and corporates. And let's say the entity in black represents the investor, which can be in the form of individuals or bond funds. So in the case of a bond, these are the borrowers and these are the lenders. Now, most of the discussion that I'm going to do in these videos for bonds and debentures have reference to the Indian capital markets. Now, in India, when the private sector companies issue bonds, they are also known as debentures. The difference between bonds and debentures is that the debentures are not backed by any security, but the credit rating of the company which is issuing these bonds is the security. So basically, agencies like CARE, C-A-R-E, ICRA, I-C-R-A, and so on, rate these companies who are issuing these debentures, and depending on the creditability of these private sector companies, the investors have to buy the debentures. Now there are different type of bonds and debentures, but let's try to understand the basic concepts behind them. So let's say that these government, PSUs or corporates decide that they want some funds in order to finance some of the long-term investments which are going to give them good returns. And in order to get those funds, they release these bonds or debentures. Now these bonds have a fixed face value, which is typically 1,000 rupees. So let's say the borrowers have issued these bonds. Now the lender is interested in these bonds. So the lender gives this amount. Let's say he buys one bond. So 1,000 rupees to the borrower. So this 1,000 rupees is the face value. of the bond. This value is also known as the par value. Now there are three cases here. First case is that the bonds can be issued at par. Which means that the price at which 1 unit of the bond is being sold is the same as the face value. The second case is that the bonds or debentures may be issued at a discount. That means less than the face value. And the third case is that the bonds or debentures may be issued at a premium. Which means more than the face value. For example, a bond with a face value of 1000, if issued at rupees 1000, it is said to be issued at par. If it is issued at, let's say, 950 rupees, it will be said to have been issued at a discount. And if issued for, let's say, 1100 rupees, then it is issued at a premium. So basically, if it is issued at a discount, the bond has a face value of 1000, but the lender had to pay the borrower only 950 rupees. Now this 1000 rupees or the face value is the amount that the borrower will be returning to the lender at the maturity of the bond. So let's say this is a 5-year bond. So at the end of 5 years, the borrower will give back 1000 rupees to the lender. Now let's take the case that the bond has been issued at a discount. That means the lender had to pay only 950 rupees to the borrower for the bond, which has a face value of 1000 rupees. So the lender paid 950, but the borrower will have to give back 1000 rupees, which is the face value. Now during this 5-year period, the investor or the lender will receive a regular payment of interest, which can be paid semi-annually or annually or monthly, which is calculated as a certain percentage of the face value. So basically the borrower is going to give some interest, let's say at the rate 10%. So this 10% will be calculated on the face value. Now this rate is the interest rate, and this is also known as the coupon rate. So this is just a term, interest rate or coupon rate. Now when we were talking about issuing the bonds and the lender giving the amount to the borrower, the first instant when the bonds are issued and the lender buys them or gives the money to the borrower, that is all happening in the primary market. Now, after the bonds have been issued in the primary market and sold to the investors may in turn sell these bonds to other investors. So instead of keeping these bonds for a period of, let's say, 5 years, if the investor or the lender, I'll write here investor so that it becomes clear. So these are also investors. So if the investor wants to take out his money and invest in something else, he can sell this bond to somebody else in the secondary market. Now, in the secondary market transactions, the bond does not have to be traded for its original issue price. That means the selling party may sell the bond at a profit or a loss. So let's say this guy bought this bond at the face value or par value, which is 1000 rupees. So he paid the government or PSU 1000 rupees for each bond. Now, after some time, let's say after 2 years, he wants to sell this bond in the secondary market. So he may be able to sell it for 1000 rupees or maybe lesser than 1000 rupees, which let's say is 950 rupees or 980 rupees, or even more than 1000 rupees, let's say 1050, 1060 or something like that. So what determines the resale value of a bond? So there are 3 factors which determine the resale value of a bond. So let's look at them in detail. So the first factor is the relative change in market interest rate. So relative change in the market interest rate. So if after a bond is issued, the interest rates rise, then the market value of the bond falls. Let's understand this very interesting concept. For example, let's say that company ABC Corp issues A-rated, this is the rating of the bond, ₹1,000 30-year 8% bond. So basically, this bond will pay interest of 80 rupees. 8% of 1000 is 80 rupees per year. Let's say the investor A buys a bond. Now, 5 years later, he wishes to sell the bond, which now has 25 years left to maturity. But now there is a newly issued A-rated 25-year bond. So now after 5 years, there is a bond available in the market which is A-rated 25 years for maturity, which is giving 10% interest, and the face value is the same, that is 1000 rupees. So basically, if somebody buys this bond after 5 years, he will get 8% for the remaining 25 years. And the face value is 1000 rupees. Whereas if somebody buys this new bond, he will get 10% on the 1000 rupees for the remaining 25 years. So why would anybody buy this bond if our investor tries to sell it in the secondary market? They will go for this bond. So, in order to make the bond attractive to investors, our investor friend must price it so that it offers a competitive return. Now, this bond is going to yield 80 rupees per year. Now, the face value is 1000 rupees. So, irrespective of the market value of this bond, the face value will continue to be 1000 rupees. And this bond is going to give a 8% interest. So, 8% of 1000 rupees will be 80 rupees per year. And now, to become competitive, the yield must be 10%. So the price or the market value must be 800 rupees. This is the market value. So that the yield to the new buyer is 10%. So for the new buyer, he will be getting 80 rupees per year in interest. And his investment is 800 rupees because he has bought the bond from the secondary market at 800 rupees. So now his return is 10% on the investment. And since the face value is 1000 rupees, he will get the 1000 rupees at the maturity period. So now this bond is as competitive as this bond. And therefore, our investor friend will be able to sell this bond to another investor in the secondary market. Now, this was the case when the interest rate had increased. But on the other hand, if the interest rates go down, investor A or our investor friend can sell the bond at a profit. So here he sold it at a loss. He bought it for 1000 rupees, but he sold it at 800 rupees. Whereas if the interest rates go down, then he'll be able to sell the bond at a profit. So fluctuations in market interest rates are probably the most important factor in determining the market value of a bond. Let me remove this calculation so that we can look at the second factor. Now the second factor is the credit rating. Now in the first point, we said that this company was a A-rated company, and the second also was A-rated. Now if after a bond is issued, the quality either improves or declines, the market value of the bond will be adjusted accordingly. Let's consider an example. Now this is a true example, however, I will not take the names of the companies. So let's say there is company A. This company issued bonds at the face value of 1000 rupees and coupon rate or interest rate of 12.25%. Now this bond at one point in time was trading at 960 rupees in the secondary market. Whereas another bond of company B, which had a face value of same 1000 rupees and coupon rate of 8.2%, was trading at 1040 rupees in the secondary market. Now this price difference is because of the risk perception of the market about these bonds. So a person who had bought bonds of company A from the primary market will make a loss if he sells the bonds in the secondary market at this rate, while the buyer of company B will make gains if he sells the bond at this rate in the secondary market. The third factor is the supply and demand. So when bonds are in relative short supply, investors wishing to sell get a better price than when there is a surplus of bonds in the market.